In 2019, investors believed a company called WeWork was worth $47 billion. That made it more valuable than many famous public companies, more valuable than some airlines, more valuable than some real estate giants. The company was everywhere. Celebrities talked about it. Billionaires invested in it. The media praised it. Wall Street expected one of the biggest stock market debuts in years. Then something unbelievable happened. Within weeks, the dream started falling apart. For years later, WeWork filed for bankruptcy protection. Think about that for a moment. A company valued at $47 billion suddenly ended up in bankruptcy court. Billions disappeared. Careers were destroyed. Investors lost money. Employees watched their stock options become nearly worthless. How does a company go from being one of the hottest startups in the world to becoming one of the biggest business disasters in modern history? The strangest part is that WeWork wasn't building rockets. It wasn't creating artificial intelligence. It wasn't inventing a revolutionary new technology. At its core, WeWork did something surprisingly simple. It rented office buildings, redesigned them, and rented desks and offices to startups and freelancers. That's it. So how did an office rental company convince investors it deserved a valuation of $47 billion? To answer that question, we need to meet the man at the center of the story. His name was Adam Neumann. Some people saw him as a visionary. Others saw him as a salesman. Years later, many investors would admit that after spending time with Adam, they felt like they were talking to someone who could change the future. That ability would help build a giant company. It would also help create one of the biggest startup bubbles ever. Adam Neumann wasn't born into Silicon Valley. He grew up in Israel and later moved to the United States. Friends described him as energetic, confident, and incredibly persuasive. He had a rare talent. He could make ordinary ideas sound world-changing. That's important because WeWork's biggest product was an office space. It was a story, and investors were about to fall in love with that story. In 2010, Adam Neumann and Miguel McKelvey launched WeWork in New York City. Their idea solved a real problem. Small businesses often couldn't afford expensive long-term office leases. Freelancers needed professional workspaces. Startups wanted flexibility. WeWork offered beautiful offices, shared spaces, networking opportunities, and short-term agreements. Customers loved it. Growth came quickly, but hidden beneath the growth was a dangerous problem. WeWork signed leases that often lasted 10 to 15 years. Meanwhile, many customers could leave after only a few months. Imagine signing a 15-year mortgage while your salary could disappear next month. That's essentially what WeWork was doing. As long as growth continued, nobody cared. But if growth slowed, the entire model could become dangerous. Then investors started calling WeWork something unusual, a technology company. That single label changed everything. Real estate companies typically receive modest valuations. Technology companies receive massive valuations. Suddenly, WeWork wasn't just renting desks anymore. It was supposedly transforming how humanity worked. The story became bigger. The valuation became bigger. The expectations became bigger. Funding rounds pushed the company higher and higher. $5 billion, $10 billion, $20 billion, and even more. New locations opened around the world. Employees celebrated. Investors competed to invest. Journalists wrote glowing stories. To outsiders, WeWork looked unstoppable. But inside the company, spending was exploding. Losses were growing, and very few people were asking difficult questions. Then a powerful billionaire entered the story. His name was Masayoshi Son. He controlled SoftBank and one of the largest investment funds in history. After meeting Adam Neumann, he became convinced WeWork could become one of the most important companies in the world. That decision would eventually help push WeWork to a $47 billion valuation. It would also bring the company one step closer to disaster. Masayoshi Son was not an ordinary investor. He was the founder of SoftBank and the leader of the Vision Fund, a fund with nearly $100 billion to invest in the future. Son believed that the biggest winners in business were not the cautious companies. They were the companies that moved faster than everyone else. When he met Adam Neumann, he didn't see an office rental company. He saw a founder claiming he could reinvent how people worked. That vision would soon unlock billions of dollars. According to reports, Son was so impressed by Adam Neumann that he quickly backed WeWork with enormous amounts of money. Over time, SoftBank SoftBank invested more than $10 billion into the company. The message to the market was clear. If one of the world's biggest investors believed in WeWork, then maybe everyone else should too. Investors started chasing the company. Journalists praised the company. The hype machine was officially running. And then something dangerous happened. Every new investment round pushed WeWork's valuation higher. $20 billion, $30 billion, $40 billion. Finally, in 2019, WeWork reached a valuation of roughly $47 billion. At that moment, WeWork became one of the most valuable startups in America. The strange part? The company was still losing huge amounts of money. In 2018 alone, WeWork lost more than $2 billion. Normally, investors expect a company worth tens of billions of dollars to have a clear path to profits. WeWork didn't. Yet many people ignored the warning signs because growth looked incredible. New buildings opened constantly. New countries were added. New employees were hired. Revenue was rising. From the outside, it looked like success. But underneath the surface, the company was spending money faster than it could earn it. At the same time, Adam Neumann was becoming a celebrity founder. Employees admired him. Investors praised him. Journalists followed him. Some people even compared him to Steve Jobs. But there was one important difference. Steve Jobs built technology products. Adam Neumann was building a story. And the bigger that story became, the harder it became for people to question it. Then came one of the strangest details in the entire saga. Adam Neumann personally owned the trademark for the word we. When WeWork decided to rebrand itself as the We Company, the company paid Adam nearly $5.9 million for the trademark. Public backlash was so intense that he later agreed to return the money. For many investors, this was the moment they started wondering if something was seriously wrong. But the surprises didn't stop there. Reports revealed that Adam had purchased buildings personally and then leased some of those properties back to WeWork. Critics argued this created potential conflicts of interest. Imagine being the CEO of a company while also acting as one of its landlords. Suddenly, investors weren't just asking whether WeWork could make money. They were asking whether the company was being managed properly. Inside the company, the culture became legendary. Huge parties, expensive events, endless optimism. Employees were told they were changing the world. Some former workers later described WeWork as feeling less like a normal company and more like a movement built around Adam Neumann's personality. Even online discussions years later often described the company as having a cult-like atmosphere. Yet investors kept writing checks. Why? Because everyone believed they would eventually sell shares to the public through an IPO. That's when the biggest secret of the entire story appeared. Private investors could see selected information. Public investors would see everything. And once the IPO paperwork became public, Wall Street would finally get a chance to inspect WeWork's finances line by line. For years, Adam Neumann had controlled the narrative. He convinced investors that WeWork was transforming the future of work. But numbers don't care about stories. Numbers don't care about charisma. Numbers don't care about hype. And when WeWork filed for its IPO in 2019, those numbers exposed a reality that few people were prepared to see. The company worth $47 billion was about to face the most important test of its existence, and it was about to fail. For years, Adam Neumann controlled the story. Investors saw beautiful offices. Employees saw unlimited growth. The media saw a startup changing the future of work. But in August 2019, WeWork released its IPO filing. For the first time, the public could see what was happening behind the curtain. And almost immediately, the narrative began to collapse. Wall Street expected to discover the next great technology company. Instead, many investors saw something very different. The IPO documents revealed enormous losses, complicated corporate governance, and a business model carrying huge risks. The company wasn't just losing money. It was losing money at a scale that shocked even experienced investors. Suddenly, the question was no longer, how big can WeWork become? The question became, can this business survive? Then analysts found one of the most alarming numbers in the entire filing. WeWork had roughly $47 billion in future lease obligations, but only around $4 billion in future commitments from customers. Imagine renting a huge hotel for 15 years, but your guests can check out next week whenever they want. You still have to pay the hotel bill, even if the rooms are empty. That's exactly what worried investors. The growth growth machine that once looked brilliant suddenly looked extremely fragile. The deeper investors looked, the worse things became. Adam Neumann had extraordinary voting power. Even after other investors poured billions into the company, he still maintained enormous control. Many institutions worried they would be investing money into a company where one person effectively controlled the future. In Silicon Valley, strong founders are admired, but unchecked power makes investors nervous. Then the media started connecting all the pieces together. The trademark deal, the property transactions, the lavish spending, the private jet, the cult-like company culture. Suddenly, Adam Neumann was no longer being compared to Steve Jobs. He was becoming a symbol of everything investors feared about startup excess. The same personality that helped build WeWork was now helping destroy trust in it, and Wall Street reacted brutally. Just months earlier, investors had accepted a $47 billion valuation. Now some estimates suggested the company might be worth less than half of that. Then even less. Every week brought another downgrade. Every week brought another negative headline. One of the most valuable startups in America was watching its valuation evaporate in real time. Inside WeWork, panic began spreading. Employees who thought they would become wealthy through stock options suddenly realized those shares might be worth far less than expected. Investors demanded answers. Board members demanded changes. The IPO roadshow became a nightmare. Instead of celebrating WeWork's future, Wall Street was questioning whether the company deserved to go public at all. Then came the breaking point. On September 17, 2019, WeWork officially postponed its IPO. The company that had spent years preparing for its big public debut suddenly slammed on the brakes. Investors had rejected the story. The dream of becoming a publicly traded giant was falling apart before everyone's eyes. Just days later, pressure from investors and board members became impossible to ignore. Adam Neumann stepped down as CEO. The founder who built WeWork from a single location in New York was forced out of the top job. It was one of the most dramatic falls in startup history. The man who convinced the world that WeWork could change everything was now being blamed for putting the company in danger. But the most shocking twist was still coming. While employees feared layoffs and investors watched billions disappear, Adam Neumann negotiated an exit package worth roughly $1.7 billion through stock purchases, loans, and consulting arrangements. Many workers saw years of expected wealth vanish almost overnight, yet the founder walked away incredibly rich. To critics, this wasn't just a failed startup anymore. It had become a symbol of Silicon Valley's excesses. Then SoftBank stepped in with a rescue package worth billions of dollars. The same investor that helped push WeWork to $47 billion now had to save it from collapse. In just a few months, one of the hottest companies in the world had transformed into a corporate emergency. And the worst part? The story still wasn't over. Because after the IPO disaster came something nobody expected, a global event that would attack the very foundation of WeWork's business model. By the start of 2020, WeWork was already fighting for survival. The IPO had failed. Adam Neumann was gone. SoftBank was trying to stabilize the company. New leadership arrived and promised discipline, cost-cutting, and a return to reality. For a brief moment, it looked like WeWork might still recover. Then the world changed almost overnight. A crisis arrived that nobody inside WeWork could control. COVID-19 spread across the globe. Offices emptied. Cities locked down. Millions of employees started working from home. Companies suddenly questioned whether they needed office space at all. This was devastating for WeWork. The company's entire business depended on people showing up to offices. Empty buildings meant fewer customers. Fewer customers meant less revenue, but the long-term lease payments still had to be paid. This exposed the biggest weakness in WeWork's business model. The problem wasn't that people hated the offices. Many customers actually loved them. The problem was financial structure. WeWork often signed leases lasting 10 to 15 years. Customers could leave much faster. During good times, this created rapid growth. During bad times, it created enormous risk. The risk investors worried about in 2019 was now becoming reality. SoftBank continued supporting the company because the alternative was even worse. Billions had already been invested. Walking away would mean accepting huge losses. So the company closed locations, reduced expenses, laid off employees, and tried to become more efficient. But fixing a company after years of aggressive expansion is far harder than expanding it in the first place. Growth creates excitement. Repairing mistakes creates pain. Meanwhile, one shocking statistic continued to haunt the company. Just a short time earlier, investors had valued WeWork at approximately $47 billion. By 2021, when the company finally reached public markets through a SPAC merger, the valuation was only a fraction of that amount. Tens of billions in perceived value had disappeared. One of the most celebrated startups of the decade had become one of the biggest value destructions in modern business history. Then another problem appeared. Borrowing money became more expensive, and investors stopped giving cash to companies that kept losing money. Suddenly, businesses had to prove they could actually make money instead of just growing fast. This change hurt many startups, but it was especially painful for companies like WeWork. The era of easy money was ending, and reality was becoming impossible to avoid. As losses continued and debt pressures increased, WeWork's position became more difficult. The company still had customers, it still had locations, it still had a recognizable brand, but the financial burden created during the years of hypergrowth never fully disappeared. The story that once attracted billions of dollars was no longer enough. Investors wanted profits, lenders wanted stability, markets wanted proof. Then, in November 2023, WeWork filed for Chapter 11 bankruptcy protection in the United States. For many people, this was the official ending of the $47 billion dream. The company that once promised to transform the future of work had entered bankruptcy court. It was a moment that shocked millions because the rise had been so spectacular. But for people who studied the numbers, it felt like the final chapter of a story that had been heading in this direction for years. WeWork restructuring information. And this is where the title of this documentary becomes important. Was WeWork itself a lie? Not exactly. The offices were real. The customers were real. The employees were real. The company solved a genuine problem for many businesses. The lie was something else. The lie was the belief that an office leasing company deserved a valuation normally reserved for revolutionary technology giants. The lie was the story investors convinced themselves to believe. History repeats this pattern again and again. During the dot-com bubble, investors chased internet companies with weak business models. During the housing bubble, people believed prices could rise forever. With WeWork, many investors stopped asking difficult questions because they loved the narrative. They wanted to believe they were funding the future. And when enough people believe a story, that story can become more powerful than reality itself. What's fascinating is that many warning signs were visible long before the collapse. The massive losses, the unusual governance structure, the long-term lease risks, the founders' extraordinary control, the conflicts of interest. None of these facts were hidden forever. The information existed. The challenge was that very few people wanted to challenge a company whose valuation seemed to rise every month. Success can make skepticism unpopular. Adam Neumann remains one of the most controversial founders in modern business history. Some people see him as a visionary who built a global brand from almost nothing. Others see him as the symbol of startup excess and investor irrationality. Regardless of where someone stands, one fact is undeniable. His story changed how investors evaluate startups, founders, and corporate governance. SoftBank also learned a painful lesson. Throwing billions of dollars at a company can accelerate growth, but it cannot automatically create a sustainable business model. Money can make a company bigger. It cannot guarantee that the company becomes stronger. In many ways, WeWork became the ultimate warning about confusing growth with success. The offices were real. The buildings were real. The employees were real. The customers were real. But the $47 billion valuation was built on a story that eventually collided with reality. And maybe that's why the WeWork story matters so much. It isn't really about office space. It isn't really about startups. It isn't even really about Adam Neumann. It's about human nature. It's about what happens when excitement becomes more important than evidence. It's about how easily intelligent people can believe extraordinary stories during extraordinary times. So here's the question. If the next $47 billion dream appeared tomorrow, would you recognize the warning signs, or would you believe the story too?